day everyone, I'm Rika Dry and today we are going to learn about specific internal control measures in accounting. These measures are very important for every business to keep their money and resources safe. By the end of this lesson, you will understand why internal controls matter and how they are applied in different areas like creditors, debtors, cash, inventory, and salaries. Let's start by understanding why internal controls exist. Imagine you have a tuck shop at school. Would you leave your inventory just lying around? Or your cash box open on the table? Of course not. Internal controls are like rules and systems that help a business protect its assets. Things like cash, inventory, equipment, and even information. If we don't protect assets, we risk losing them, and no business wants that. If you think about the assets you own, your school bag, your books, sport equipment like a soccer ball, cricket bat, tennis racket, cash, how do you keep these safe? You may have a locker at school where you can lock up some of your belongings, or carry your cash with you while at school, or put it somewhere safe at home. Businesses also need to think in this manner when it comes to their business assets. Next time you visit a shop, see if you can spot some of the measures they are taking to safeguard their assets. Now, what if someone tries to steal from the business or makes a mistake when capturing sales? Internal controls help prevent fraud, which is stealing or cheating, and they also reduce errors. Think of it as your spell checker and antivirus program, all in one, but for money. An example would be if no one checks payments, someone could steal money or pay the wrong supplier. Imagine if you kept forgetting how much airtime or data you've bought. Soon you'd run out of money, right? The same with a business. We need to record things accurately so we know how much we've earned, spent, or still owe. Controls help keep our financial story correct. If our financial records are accurate, then the people who uses these records will be able to trust the story it tells, and that will then lead to good decision making. This would be similar to a coach and a captain of a sport team creating a game plan based on player statistics. If the statistics are wrong, either of their own players or the opposition, the game plan will not be optimal. Ever tried to bake a cake with no recipe? Chaos, right? Internal controls make sure a business runs smoothly. Everyone knows what to do, when to do it, and how to do it. That's what we mean by operational efficiency. Less stress, fewer mistakes, because everybody knows exactly what to do and what to expect. Rules can be annoying until you realize they protect you. In businesses, internal controls make sure staff follow the rules and policies. For example, don't give discount unless the manager approves. It's not about being strict, it's about keeping things fair and legal. Can you imagine all the players in a soccer team standing together because all of them decided to play goalie for the match? Or all the forwards in a rugby match standing with a hooker to throw the ball into the line-out? Or all the fielders in a cricket team running up together as bowlers? Just like everyone in a sport team knows the rules of the game and what is required of their position, all employees in a business are part of a team, and if there is proper internal controls or rules that tells what to do and how to do it, then the business will run smoothly. Can you think of examples at school where the school has rules that you need to follow? How does that keep you safe? How does it keep the rest of the learners at your school safe? And how does that keep the teachers safe? If we think about policies, there might be a policy that limits spending. For example, that only managers can approve purchases over R1,000. A password policy to protect the data on computers, where staff must change passwords every 30 or 60 days. A cash handling policy, where 2 staff members must be present when counting cash. A policy regulating the use of assets. For example, laptops may not be taken home without written approval. There may also be a policy regulating internet and data security. In a business, there are many different parts that need controls. Today, we will look at 7 key areas. These are creditors, which are the people or businesses the company owes money to; debtors, who owe money to the company or business; petty cash, for small expenses; cash transactions; inventory; fixed assets like vehicles and equipment; and salaries and wages. Each of these areas has specific steps to keep everything in order. We'll take each one step by step. First, let's look at creditors. These are the suppliers we owe money to. To control payments, businesses must make sure documents like invoices and statements are carefully checked and approved. Different employees should prepare and authorize the payments. This way, no one person has too much control. Before paying, the business must compare monthly statements from creditors with their own records to confirm the amounts are correct. This is called a creditors reconciliation. Finally, payments must be made on time so the business does not have to pay any extra interest. Now, let's talk about debtors. They are the people who owe the business money. When a business sells inventory on credit, a debtor's account will be opened for the customer who bought the inventory from the business. Only authorized employees should approve credit sales. Debtors' accounts must be checked regularly to see if any payments are overdue. If customers don't pay on time, the business must follow up or take action. When it is clear that the debt cannot be collected, it must be written off as credit losses. All transactions with debtors must be recorded accurately so that the information is correct. Otherwise, money disappears and nobody knows why. Petty cash is used for small day-to-day expenses like buying tea, coffee, milk, sugar, or stationery. It is a small predetermined amount of physical cash that is kept in a cash box on the premises of a business. Only approved employees should handle petty cash. There should be a limit on how much can be spent at once. Every expense must be supported by a petty cash voucher and a receipt. Before the payment is accepted, it must be authorized by someone responsible. This helps prevent the misuse of petty cash funds. All petty cash transactions is recorded in the petty cash journal. Cash is one of the most at-risk assets, so strict controls are needed. All physical cash received must be deposited daily at the bank. Please don't keep it in a drawer or in a jar or even under your mattress. Only certain staff may handle EFTs, that is, electronic funds transfers. All cash received must be recorded in the Cash Receipts Journal, and all cash payments must be recorded in the Cash Payments Journal. The business must compare deposits and payments with a bank statement regularly to make sure everything matches. When a business does this comparison, it is called a bank reconciliation. With cash transactions, it is also very important to separate certain functions. For example, the person receiving the cash and the person making payments may not be the same person. The person requesting a payment should not authorize the payment. A third person can, based on the authorization, make the payment, and a fourth person can then record the payments in the Cash Payments Journal based on the source documents that are provided. Inventory, also called stock or goods, also requires good controls. When inventory is ordered, the order must be approved by a manager. When the inventory arrives, employees must check it carefully against delivery notes and invoices. Inventory must also be stored securely to prevent theft or damage. Regular inventory counts must be done to compare actual quantities with the records. If there are any differences, it must be investigated and corrected. Have you ever gone to a shopping mall or a store and then there was a sign on the door saying, "We are closed today for a stock count"? That means that business was busy counting all the inventory to determine the actual quantities for their records. Fixed assets are things like vehicles, machinery, equipment, and furniture. All assets purchased must be authorized and properly recorded. The business keeps an asset register with details of each asset. Any movement or disposal of assets must be approved and recorded. To protect assets, they should be checked regularly to make sure they are still in good working order. In other words, a business should do maintenance and, as needed, repairs. An example of this that we often hear about is Eskom taking some of their power generating units offline to do repairs and maintenance. Let's look at salaries and wages. Accurate payroll records must be kept for every employee. Timesheets or other proof of work must be completed to show that employees worked the hours claimed. Think of a clock system where an employee needs to tap with an employee card to indicate that they enter or exit the place of work. Before payments are made, they must be checked and authorized. Before payments are made, the payments must be checked to ensure accuracy and authorized. Where possible, salaries should be paid electronically. This reduces the risk of cash being lost or stolen. Can you imagine working for someone and then not receiving the correct amount of money for the work you have done? These controls protect the business from paying too much and employees from receiving less than what they earned. It also ensures that pay as you earn is correctly calculated and paid over to the South African Revenue Services. Pay as you earn is a portion of income tax that is deducted from the salary of an employee. I want to emphasize the importance of segregation of duties. This is one of the most important control principles. This means that different people must do different tasks. I'm going to pause for a few seconds and allow you to just have a look at this image. What different duties can you identify from this image? Can you see how each of them are separated? One person orders the stationery. Another person authorizes the transaction. And another person records it. We can also add another person handling the asset or the money. This prevents fraud and makes it easier to spot any mistakes, because no single person controls the whole process. If you think back to all the areas we have discussed earlier, segregation of duties is like a golden thread that runs through all the business processes. I want you to remember the 5 golden rules of internal control. Think of them as your Avengers team or the bodyguards of business processes. Authorization. Only the right people makes decisions of whether a transaction can continue or if it should be stopped. Accurate record keeping. What we write down must be correct. Regular checks and reconciliations. Always check, double check, and match. Segregation of duties. Don't let one person do everything. Security over assets. Lock it, track it, and secure it. Let's have a look at this image. Can you spot the internal control mistake? Yes, there's no control over the security of the cash, and the inventory is not secure. So the thief came in and helped himself to some of the cash because the cash box is unlocked, and he can also take some of the snacks the boy is selling. Let's try another one. Can you spot the internal control mistakes in this image? There's a lack of proper receiving procedures. The employee is not checking the delivery properly. There's no comparison of the invoice or the delivery note to the actual inventory received. This increases the risk of receiving the wrong items, damaged goods, or incomplete deliveries, and no one will know. There's poor security over inventory. The inventory is dumped outside in the rain. The warehouse is open, yet the goods are not stored securely inside. This leads to risk of theft, water damage, or spoilage, especially in this weather. There's no physical protection of assets. Cash is visibly sitting in an open box in the rain, completely unprotected. This violates the principle of securing valuable assets like money and inventory. There is no supervision or authorization. There's no sign of a supervisor or anyone authorizing this delivery. The delivery person is just dropping the boxes and driving off. This shows a failure in the authorization principle. Who confirmed this delivery was expected? And there's a lack of operational efficiency. The employee is shivering, overwhelmed, and not doing his job efficiently. This could be due to a lack of training, unclear responsibilities, or no defined procedure for how deliveries must be handled. Today we learned that internal controls protect the business from fraud, errors, and loss. Loss can occur through theft or even damage. We looked at controls for creditors, debtors, cash, inventory, fixed assets, and salaries. Every area has special steps to make sure money and resources are kept safe. Please remember that there are some principles that runs throughout every single one of these processes. So if you remember anything, it would be authorization, record keeping, regular checks and reconciliations, segregation of duties, and security. Thank you so much for joining me today. Remember, the goal is not just to pass accounting, it's to understand how the real world works. These internal control measures are your first step into smart business thinking.